Well, next week, the Bank of Canada is widely expected to cut interest rates for a third consecutive meeting. It comes at the same time many Canadians have been feeling the pressure of higher rates, particularly in the mortgage market. And with a wave of mortgage renewals expected in the coming years, it has raised questions about differences between mortgages in Canada and the United States. In fact, one of our BNN Bloomberg viewers asked us about this very issue recently. And so we thought we would ask it to an experienced business executive on both sides of the border. Bob Kelly is the former chair of the Canadian Mortgage and Housing Corporation and also the former CEO of Bank of New York Mellon. Bob, it's great to have you back with us. Nice to see you.
Hi, John. Thanks for having me.
We sometimes plow right into storylines without thinking about all of the context. I thought this was a great question we got from a viewer on why this market is dominated by shorter duration mortgages, and in the U.S., they typically have these longer 30-year mortgages. What is the reason for that, Bob?
It's a great question, actually. You'd have to go back to the 80s. And essentially, our markets in Canada and the United States were identical. You basically had bank lenders. They called them at the time S&Ls, which a few of your listeners may recall, savings and loan companies, and regular banks, and they did most of the lending. And that was true in Canada, too. The big difference at the time was that the United States had 40,000 different banks in the United States. They now only have 4,000, so 1/10 the amount. And I'll come back to that. And in Canada, of course, we just had the big, strong banks and, let's say, a total handful, two handfuls of banks. So same product on balance sheet, originating loans for Americans and Canadians, but many players that were not healthy. So what happened? There was this huge recession that occurred. Some of you may recall it in the early 80s when Paul Volcker put up interest rates. Deposit rates went through the roof. Deposit rates were higher than the lending rates. It got really ugly. About 800 banks, the so-called S&Ls, went bankrupt, and it affected a number of banks in economies that were very sensitive to that as well, particularly Texas and a few others. So, meanwhile, it didn't happen in Canada because we had big, stable, profitable, well-regulated, well-managed banks. So let's fast forward a little bit to probably the late 80s. And what happened there was they said, okay, we got a whole bunch of little banks. Things didn't go well, so let's change from a lender market to a securities market. So in other words, let's originate all these mortgages, and then we'll turn them into securities, mortgage-backed securities, MBSs, and we'll sell them to people, and we'll make a lot of them government guaranteed. And we didn't have to do that in Canada, but it created a gigantic securities market in the United States. Today, it is close to, the MBS market is close to $11 trillion. So we had this very new market, and that market was severely tested in 2008, and it failed. You may recall what happened to the housing market in the United States. There was a huge amount of fraud and mismanagement in the mortgage-backed securities market, which I won't go into here, but it was ugly, and housing prices went down 30%. Meanwhile, north of the border, we didn't have a big securities market. There's a little tiny bit of activity, but not much. Housing did not tank, which was wonderful, and the banks held up very nicely in that market with good regulation, good management, good profitability. So here we are today, and that's the history of how it happened. But it took 40 years for the U.S. to go from a lending market to a securities market, and they're still working through some of the issues on that.
And so I guess that is one of the reasons why there's a higher level of comfort in our market with having shorter duration mortgage products, where in an environment like this, where we're talking about renewals, there is a little bit of fear amongst Canadians. And if I could add an element to that, when people have been comparing the two economies recently, they've often cited those longer duration mortgages in the U.S. as perhaps protecting some American homeowners from sticker shock on interest rates in this current environment. So after that long history lesson, which was very helpful, what makes sense today? Like, does it make sense to maintain a shorter duration mortgage market in Canada versus the U.S., just given where we are now?
No, so that's a great question too. And in theory, there's no reason why we can't have a long duration fixed rate instrument in Canada. But let's talk about it for a second. Firstly, Canadians have easy access to mortgages through their branches and mortgage brokers. They already have 30-year amortization, just like the United States. Canadians have something far better than the United States. They have what's called portability. That is, if you want to change houses, you can move your mortgage from the old house to the new house. You can't do that in the US. That's a huge problem. Or if you're moving from, say, New York to Florida, which a lot of people do, you would have to get rid of your old mortgage signed up, say, 2 or 3 years ago at a very low rate. You'd have to take one at a very high rate. And that actually creates big problems, and portability and non-portability creates huge problems for an economy where mobility of labor is really important. Last thing I'd say is about that in terms of thinking about it is Canada does have a 10-year product, but there doesn't appear to be anyone interested in it. They'll go for 2 years to 5 years. 5 years tends to be the norm. You can go to 10 years, but it's more expensive. So listen, in the end, could we have it? Yes. So it's a little bit like the old Kevin Costner movie, Field of Dreams. You'll build it and they will come. There'd be a lot of work to do. And you'd have to figure out, firstly, what's the instrument you want? It's not just a 30-year fixed rate. Americans have 2 other fantastic things that we don't have in Canada. First one is they have free refinance option. If over the 30 years rates go down, you can refinance on every time on that at the lower rate. So your rate won't go up, but it can go down through refinancing. It doesn't cost a thing other than a little bit of fees up front. The other thing is you have no prepayment problems in the United States as a borrower. You have free prepayments. In other words, you're not penalized by just wanting to pay early. That doesn't exist in Canada. So you'd have to figure out what the instrument is. You'd have to figure out your investors. The reason why a 30-year didn't exist in Canada is because banks hold them on their balance sheet. Most of their liabilities go out to 5 years. They don't go out to 25 or 30 years. As a result, they don't love long-dated mortgages because it creates the mismatch between the loans and the deposits that can be unbelievably risky. And then there's a long list of things we'd have to figure out. There'd have to be Bank Act changes. You need a sophisticated mortgage servicing system for these securities. You need trading systems for liquidity and price discovery. You'd need a very different regulator and regulatory buy-in. And you'd have to think through what's the role of CMHC and the government generally afterwards. Today, CMHC only insures about $400 billion worth of mortgages. Those are the mortgages with less than 20% down payment. It would have to be a much bigger market. And so there'd be a lot of things to think through. You couldn't do it overnight. You could do it over time. And the question is, do you have enough investors, pension funds, securities companies for mutual funds and ETFs and pension funds, beyond that, insurance companies that would actually buy these things instead of banks. Banks would probably own some of them, but not that many. So it would be a long-term project, but it could happen over time.
Bob, I knew you were the right person to ask this question to. This has been great. I'm going to try to squeeze one final one in. Do you think just the fact that people have to be thinking about renewing their mortgage at a relatively quick pace in this country, that actually opens the door to a conversation around mortgages? You talked about portability, things that people might just benefit from understanding and having a more frequent conversation, the same way that, if you're looking at your investment portfolio and talking about it and looking at it, then you might be more informed.
I tend to be a pretty conservative person. So I would try to get the next rate, I try to get the longest rate possible to give you surety of your cash flows at home, just like you have investments, but you have a loan in this case. So I would go for the 5-year product. And I would try to get the best rate you can, either through your branch or through a broker. And you're not going to get mortgage interest rate deductibility, so bear that in mind. I just think you need to be conservative, and that's the way I do it. I know a lot of people right now are electing 1 or 2 year mortgages, but I'm not sure that's the right thing for most Canadians.